Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play, and markets are obviously dominated right now by geopolitical tensions in the Middle East with the war on Iran. Yesterday, we saw a pretty notable reversal in the markets where markets opened up about a little over 1% down on the day, only to close back up flat on the day, a pretty significant buy the dip event, despite the fact that we saw some pretty significant headlines. You had the we saw across the board some sell-offs with the airlines, the cruise operators, travel and leisure stocks broadly across the board selling off. At the same time, we saw, defensive names, specifically energy names, see some significant gains on the back of significantly higher oil prices, significantly higher natural gas prices, shipping containers, defense stocks, cybersecurity stocks, gold miners, and a generally flight to quality with regards to the mega cap tech names like just Nvidia, Microsoft, all attracting bids on the back of yesterday's price action. Right now, probably the biggest unknown is really potentially how long this war in Iran is going to last and what that means for gold, what that means for oil prices. That's probably in at the moment the biggest concern. VIX spiked to over 23%. I expect that's going to be even higher as of today. We do expect that, with based on where futures are right now, the markets are going to open sharply lower from where we closed yesterday. We expect oil to open up higher than where it was yesterday. This kind of, I would say, largely overshadowed the um, ISM reading that we saw here yesterday, or ISM reading that showed that inflation is potentially a concern again. We're at the point now where the chances of a 50 basis point cut in 2026 is lowered now as a result of the higher than expected inflation print that we saw. So there's a lot happening at the moment. A lot of it is going to be contingent upon how the war in the Middle East shakes out, which is obviously very fluid at the moment. Quite difficult to gauge how that's going to shake out and what the impact on it is going to be for the equity markets. Initially, the equity markets, I would say, to some degree, shrugged off the tensions, with obviously the exception of the energy space having the biggest impact. I do think long term, the impact at U.S. equities is going to be on the minimal side. However, that doesn't mean that in the short run we won't see some significant volatility, especially driven off of the the energy markets. We have seen Asia continuing to sell off here. We have, South Korea essentially the markets crashed 7% here on Tuesday. You have some of the memory chips out of Samsung and SK Hynix kind of collapsing overnight. So there's definitely contagion that has spread out outside of the Middle East into tech, into other markets that I think is going to be critical to monitor. But overall, we certainly expect in the short run more volatility ahead. What's interesting is that kind of the big name tech has actually benefited from all of this. This is probably just simply a flight to quality. People selling anything that is deemed risky and kind of rotating that back into tech. We've seen this great rotation here over the last 4 or 5 months now out of tech. But we're now seeing, as a result of geopolitical tensions, the sell-off across the board that is then rotated back into tech. Like I said, we saw a pretty significant selling across uh, the cruise operators, anything related to travel, like airlines, hotels. Those were kind of the hardest hit stocks. And it was really energy and tech that saw that rotation into those specific sectors. So, at the moment, if you look at the S&P 500, the S&P has been sort of range bound here between this 675, 680, and the 700 level on SPY. We do expect that will open up potentially below those levels here today. If you look at the pre-market right now, we're expected to open up at 675. We'll see if those levels can hold or if we break below that. I have a hunch that opening up at 675 is going to open up further downside below. So that's really something I think we need to be quite careful of, given the fact that this is a major support level that essentially has held since December, is now cracked. The downside risk here is really a pullback here into the 650 level. Those were the prior lows from November. That would be our initial downside target opening up below 675. So we have to be quite careful with the markets today after where we open up this morning. If you look at the NASDAQ 100, the Nasdaq has been weaker. The 600 level has been the major support level that has been holding here. If you look at pre-market here, it looks like Nasdaq's going to open around 595. We're going to be below that 600 level here. The key support levels below that is going to be in the 570, 580 range here to the downside. That would be our initial downside target, but extended targets down here go down to the 550 level here on the Qs. Small caps holding up a little bit better than the rest, but we'll take a look at that. As you can see, small caps holding this 257 level here over the last month or so. So far, if we look at small caps, that's opening up around 257 or so. So we're still just about holding, this major support level here right now. Interesting to see small caps holding on better than the S&P and the Nasdaq. If you look at RSP, the equal weight S&P 500 index, we're opening up around 201. So that is also holding up a little bit better than the S&P 500, still holding up well above that prior support at 200 right now. If we break below 200, our downside target's around 195, 194 here to the downside for RSP. So the rest of the market actually managing to hold on a little bit better than the market cap weighted indices. So those are some of the things that, at a very high level to be paying attention to. If you look at international stocks, they generally so far are also holding on a little bit better at the moment. If you look at, um, for example, VT, Vanguard Total Market, Total World Stock ETF, this kind of covers international equities. Uh, you know, is- Unlike the S&P 500 has had significant outperformance here since November. So, still outperforming the S&P 500 at the moment. We also have kind of dividend stocks, VIG. also outperforming here in this market environment, which is not particularly surprising, again, as there is more of a flight to safety in this uncertain environment that we're in right now. So that's kind of where we are looking at from a macro perspective. As we look to um, the equity markets and individual securities, there's two places or three places that I think will likely continue to see kind of some of the strongest reaction today. Specifically travel stocks. If you look at yesterday, the airlines actually, compared to the cruise operators, didn't get hit so much. Um, the cruise operators got hit more than the airlines. And I think those are two industries that are still going to see some bigger impact, whether you look at American, United, Delta, those are ones that I think could see some further downside here today based on kind of price action and what we've seen so far. Um, Energy stocks is definitely one that I think is worth paying attention to here. So, for example, if you look at United Airlines, we started to break down below this $100 support level here, 101 support level here, where I would expect that today we're going to open up below those levels here. Most of the major airlines are kind of trading near some of those support levels. United Airlines, I think this morning is going to open up somewhere around that $99 mark, so below that $100 level. And that opens up, United down to that $90 level here to the downside. So whether you're looking at United Airlines, whether you're looking at Delta, whether you're looking at American Airlines, they all follow a similar pattern. Um, Carnival Cruise, Carnival Cruise, as you can see, opened up here yesterday just above this $28 support level here. I do expect that today. Let's take a look at where we are pre-market here we're looking at around opening up around $27 here, so below that $28 support. That really starts to look at potentially 24 and a half support level here to the downside is our next downside target here for Carnival Cruise. Those are some of the big movers that I expect. On the flip side, energy stocks, just looking at XLE, for example, but specifically, if you want to look at specific energy names, we'll take a look at a couple of them here as well. But XLE, as you can see, continuing that upward trajectory here. It has generated that counter trend bearish signal, which shows us that the trend has gone so far so fast that there's a higher likelihood of a consolidation here. But these are extraordinary times where fundamentals will override the technicals. And this is really where my expectation is that even though markets are stretched, there is still plenty of room for this to get further stretched given the the conditions that we're in. So XLE is pre-market is meant to open around 57, 53. So we are expected to open up a little bit higher here within yesterday's range. So we'll see if we can push back above yesterday's range. The high was around 57.88. See if we can get back above those levels. If we do, I think energy stocks have further room to grow here. But I do want to point out, the liquid natural gas stocks, Qatar, which we see about 20% of the world's flow of liquid natural gas flow through Qatar. Um, that's one of the countries that are currently being affected by all of this. And that's really where we think that there's going to be some significant upside for liquid natural gas stocks. Like so LNG, which is probably one of the largest, as you can see, broke out above this major resistance level, which sits around 243. This is essentially, whoops, 243 was essentially the highs from last year. This was a stock that was already on a pretty strong upward trajectory prior to the war in Iran, and now this has just simply accelerated that higher here above that 243 level here. LNG, if we look at LNG here, pre-market here, that's expected to open up at 259. So we're talking about another $11 higher here on LNG. So LNG, which is one of the largest liquid natural gas providers here. The second other one is EOG. Sorry, EOG. Very similar story to LNG in terms of last year. We see this 124, 125 level as kind of that resistance level. It traded up until that level a few days ago as it really kind of spent the last couple of days building that base. Yesterday was kind of the breakout here above that level. We're opening up around 131 here, so opening up above 130. This is really where there's, again, further upside potential here for these liquid natural gas stocks. Overall, you're going to see, anything related to energy benefit from this, whether that's Exxon or Chevron. My suggestion to you, if you're looking at those specific names, is to stay with the major operators from a liquidity perspective, because you go once you get down the chain with regards to energy stocks, the liquidity drops off pretty significantly. So really stick to the major players in liquid natural gas or the major consolidated oil stocks. Those are the ones that I would generally stick to. The other sector or industry to be paying attention to here right now are defense stocks. So whether you're looking at stocks like Lockheed Martin, Northrop Grumman, RTX, those are the stocks that also, in recent months have seen some significant gains, and we expect over the next couple of days, likely we'll still see some further expansion as this war seems to have expanded even further from what we saw over the weekend. So, in the short run, expectations are going to be for more volatility. We obviously expect that things can change very quickly. So this is one where, unfortunately, to be trading this market, you really have to be glued to the screens to some degree, because reversals, given the volatility, given the speed at which things are moving, things can reverse fairly quickly. I do think that one thing that is kind of being pushed to the sidelines because of the geopolitical tensions was really the February ISM manufacturing report that came out significantly worse than expected with regards to prices paid. It came out significantly higher than expected. The January reading was 59. The February reading was 70 plus. Um, that's a sign of a pretty painful inflation surge that we really haven't seen since 2022. That's the highest reading we've seen since June of 2022 when some of these tariffs were being embedded. And that's really something that I think we need to be paying attention to underneath the surface because, you know, prior to the war in Iran, there was a lot of optimism with regards to whether or not we're going to get two or potentially even three rate cuts, that the labor market was stabilizing, inflation was moving in the right direction, and that we were going to likely see lower interest rates and yeah, we were going to see lower interest rates and potentially, three rate cuts here for this year. But at the moment, you have 10-year yields that's back up above, over 4.1%. Treasuries have sold off as a result of the war in Iran. So interest rates are spiking higher here again, and again, that's a combination of, selling treasuries as well as the higher than expected inflation print. And that is probably the longer term impact economic event that we should be paying attention to, that essentially is being drowned out as a result of the war in Iran at the moment. So a lot is going to happen here over the next week or so. It's really hard to gauge, how this is going to play out here, even in the short run, because, war is hard. It's really impossible to predict how this is going to play out. It's even harder to predict how markets are going to react to it. The VIX is now approaching 29%, which is certainly showing that getting to levels that typically would be considered stress. Markets are quite stressed. Now, the thing about high VIX is that generally speaking, that is um, a contrarian indicator, so that, as VIX gets higher and higher, those become, buying opportunities. But I don't, from my perspective, I don't necessarily know that today is going to be the bottom and today's going to be the buy the dip that everyone's looking for. I think we might see that maybe later this week, depending on how things shake out here with the war in Iran. But at the moment, there's a bit of a war on attrition with regards to, how long can these regional countries in the Middle East continue to counteract kind of the ballistic missiles and drones that Iran continues to fire. It's really hard to gauge how long that back and forth will last for. Who is going to outlast who? Obviously, $20,000 drones versus $4 million interceptor missiles is a math equation that's very lopsided. But at the same time, between U.S. and Israel, they are hitting Iran pretty hard with regards to their capabilities of going on the offensive, and it's very early days. It's very hard to see or understand how that's going to play out here. With the Strait of Hormuz effectively closed, in the short run, the energy market is really what's going to be driving kind of volatility here in the short run. So that's really where I would be paying attention to the most, is the energy markets, how the energy stocks are reacting, how Brent, how crude futures are reacting. That's going to give you probably the most real-time signal from the markets as to, the sentiment of this war in the Middle East. With that, that covers what I wanted to share with you here today. Obviously, a lot to ingest, a lot to take on here, a lot to continue to read over the next few days. I hope that this gives you a bigger context around, where to be focusing your attention on, and we'll continue to be back here every single week to keep you updated and give you a sense for how we're thinking and how we want to be positioned here for the market. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here next week.